Let's get across the market open. Marcus Padley joining us on Marcus today. Marcus, welcome back. First time we've caught up with you in the new year, and what a start to the year it has been, of course, dominated by those geopolitical themes. How are you navigating this at the moment? What are you watching?
Oh, Andrew, I tell you, we are still sitting in cash watching the markets recovering in the US, and just an extraordinary start to the year. Gold price is up 20% since December 31st. The US dollar, as everyone's talking about, has just hit a 4-year low. But, you know, we were worrying last year about a 10% drop in the US dollar. It's dropped 3.7% in a week. And all this sort of comes after this Japanese bond blow up, which seems to have blown over. And I can't help thinking something ominous is going on. And if the US dollar is going down so rapidly and the gold price is going up and silver and all hard assets, it tells you that someone somewhere is positioning for some sort of capitulation in the US market, particularly the US currency. And you think about we've always keep talking about the big one, which is where the US loses control of the bond market. It's not happening, obviously, except that clearly there's some positioning going on at the moment for it. Anyway, what I'm looking at is an expensive market. The Nasdaq PE is 33 times at the moment. If you were to walk up to a businessman like myself and offer me 33 times my last year's earnings to buy my business, I'd knock you over in the stampede. Yet here we have, what is it, $50 trillion worth of stocks trading at that price. So I think we're in dangerous territory. The S&P 500 PE is 29.3, RPE is 24, long-term average is 18. We're setting up for something. The best bits of a market are always where everybody loses their head. But the markets are supposed to go up 9.5% per annum on average. That includes dividends. And we're just going parabolic here with a few themes. I think I hate to say, I hate be a finger wagger, but it's looking pretty dangerous, I think.
Nonetheless, does it make you just a bit nervous that you're sitting on the sidelines watching this? And I mean, you certainly refer to commodities in particular, the rally we're seeing going on there. You feel as though you've missed out there?
Oh, we've definitely missed that. But when we cashed up at the end of last year, gold, and we could see the gold price rallying, and we could see resources, and I'm never comfortable buying into themes like, with other people's money, themes like uranium and lithium. It's always fickle short term, so didn't buy in. And when we cashed up and looked at gold, it was already up 45% that year, and here we are another 30% higher. So it's all momentum, Andrew. We now do ETF research. I don't think anybody researches ETFs. They don't look beyond the marketing messages on the front of the box. So the Wire ETF, for instance, which represents copper stocks, I think money piles in without any regard for the underlying fundamentals on the companies. It's the same in the tech ETFs as well. There is no value around if you drill down, as we now do, into the underlying stocks in an ETF. People are buying the themes. And the theory is that there's you've probably heard the expression MOMO, which is just momentum trading. It's almost as if every theme is a hydraulic piston, and if one piston gets pushed down, another one gets pushed up as the money moves from one place to another. And at the moment, it's all just flying out of what we were doing last year into gold resources, and they're quite narrow themes. And I sort of think we're playing a system in a casino, and there are a couple of tables over there shouting and whooping. We don't have to go over there. We're just going to keep playing the game, and our game tells us there's something dangerous going on in the market. Otherwise, the gold price wouldn't be doing this. Otherwise, the US dollar wouldn't be doing this. And we have to watch and wait to find out what it is. But it's ominous, not fantastic, I think.
Well, some key events this week to watch, of course. Certainly, as far as some of the major mega cap tech stocks that are reporting, how pivotal is that going to be, do you think?
I think pretty pivotal. One of the ETFs we made a fortune out of last year was FANG, of course, but all these US-based ETFs, they are running against the tide in Australia if the US dollar goes down. So things like FANG are actually 15% off the top, and that is an opportunity if these results are okay. We're convinced that, well, we don't need to be convinced, it's a fact. AI is here to stay. These data centers will get built, and ultimately it is so fantastic as a development. We will all be paying for it, so the earnings will come at some point. Whether these results bottom share prices in the short term, whether they mark the bottom now, we'd like to be buying into AI again at the right price. FANG looks right. It's been squashed by the currency. So the results are very, very important, but the bigger theme is for us trying to time re-entry into AI, because I'm pretty sure these hyperscalers are going to make a fortune. It's here to stay, and obviously they're very short term. These results are very important, but the more interesting thing is the Fed meeting tomorrow morning, 6:30, which will be the press conference, and it's a show, isn't it? Powell versus Trump. And he is likely, or could be, deliberately uncomfortably hawkish just to upset Trump. And there is a vibe that inflation in the US is out of control. It hasn't been picked up in the numbers because of the government shutdown creating a mess. And this is why Trump's pushing affordability, because he wants inflation under control and everyone spending for the midterms and feeling good. But there is every chance that one of the post-it notes for this year will be US interest rates bottomed a lot earlier than we thought, in line with the rest of the world. And we could hear that tomorrow. So that's going to be very interesting.
Well, and also locally, we get that key quarterly read on inflation today. Marcus, ahead of the RBA meeting next week, what's your view on how well or if inflation is contained here in Australia?
We're looking for numbers, what is it, 0.8 and 3.4, is it? So compare it to that when it comes out, 0.8 and 3.3 core numbers. There's now a 60% chance of a rate rise next Tuesday at the RBA meeting, and obviously this feeds into it. So important number today could push our market around a little bit. I'm glad I'm not sitting on $1 million mortgage. Because interest rates in this country seem to be one way at the moment, and it would devastate a lot of people to see a rate rise as soon as February. But after that strong jobs numbers last week, that's the chat. So we'll see what happens.